Welcome to the Personal Pension Radio Podcast, where it's all about helping you complete your financial journey to retirement. Discover time-tested strategies and get unconventional insights into wealth building and retirement that actually work. Break away from the herd and go for the retirement you dream of. And now, here's your host, the income engineer, Kraig Strom.
All right, back on Personal Pension Radio. Thank you so much for joining me again. I really appreciate all of the feedback. I have just been loving the feedback, the emails, the questions. Thank you so much. And if you haven't left your review on iTunes, please do so. Go to iTunes, leave a review. iTunes, if you didn't know this, is one of the largest search engines on the planet. I mean, it's one of the single biggest places that people search for information in the world. And they are driven by much of the same things that drive all other search engines. Things like reviews and activity will drive how high you rank in the searches. So if you want to, take a moment, leave a review there on iTunes for Personal Pension Radio. I would truly appreciate it. Now, as you heard in the intro, I am the income engineer. I actually adopted that title after I trademarked it because I love the conversation around retirement income planning. My mission is to deliver that retirement dream that Wall Street has promised for so many years. Wall Street tried to teach me retirement planning, but they only got it half right. They didn't really teach me retirement income planning. They missed the comprehensive nature of retirement income planning, and I want to help you pull back the curtain on that mainstream financial advice so that you can ask the right questions, so that you can be prepared for the retirement income challenges that most people are headed for and they don't even know it. Now, I want to jump in. I want to make sure that you know that in the world of financial planning, okay, that is a big, broad term. Something came up recently. This just pops up all the time. But people ask, well, what do you do? I say, I'm a financial planner. And inevitably, it doesn't happen every time, but inevitably, people will make their own judgments. And they'll say, oh, that means you do investments, or you do life insurance, or you do, they basically pigeonhole, hey, I'm a financial planner, and oh, you do X. Because they don't realize that in the world of financial planning, you can find folks who are either new in the financial planning career or that are very specialized in one area only, or that's the only area they've learned so far, and they will be in that specific, category. And then you've got guys like me, certified financial planning professionals that have been around for about 20 years, that when you ask me what I do, the reality is I actually help my clients in a very comprehensive way. The conversations that I have with my clients go across many different categories, from the legal and estate world and how your assets are established and protected, to investment account reviews and IRAs and Roth and 401ks, life insurance, both term and cash value, disability insurance to insure your paycheck, long-term care planning. I'll have conversations with clients about reverse mortgage planning, retirement income planning, of course. The reality is, if you meet with a qualified financial planner, you're going to have conversations about everything in your financial and estate world. That's the key. You've got to find someone to talk to who's not going to just pigeonhole one particular conversation. You've got to have somebody that's able to span all of these different areas. And that's the answer to the question when people ask me, you're a financial planner, you do X. I say, well, no, I actually do it all. I am extremely comprehensive in my skill set. And I'm not talking about, oh, I dabble in this and I dabble in that. I have experience in depth in many different areas across the financial planning scope of experience. And if I don't have the depth I need to talk about captive insurance, for example, I've got that specialist at the table the next time we meet, right? I have all of those resources at my disposal to cover charitable trust and foundation planning? Absolutely. I'll have one of my attorney partners in the room on our next conversation, right? That's the key to a comprehensive financial planning relationship. So I thought I'd share that in an answer, kind of an answer to a question that's been out there the last few weeks. And there you go. Now, quick disclosure, right? So there's my disclosure. Here's my disclosure. I am not an attorney. I am not a certified public accountant. I am a certified financial planning professional. All that being said, and as qualified as I might sound on the radio or the podcast, please don't act on things that you hear on this show as if you're hearing advice for you in particular. This show is meant to give you information to prompt you to take action, not to actually go and do things based on things that you hear on this show. And please, dear goodness me, do not act on things that you hear from financial entertainers. Financial entertainers are people who are not licensed, they are not regulated, they are not monitored as financial planners in any way. And yet they're on the radio and they're on podcasts, they're on TV, throwing out financial advice and writing books under freedom of speech, giving out financial advice. Please meet with a qualified financial planner before you actually take action. Somebody that operates under a code of ethics, a regulated process that goes through the full financial planning steps before you actually make a decision. Now, this week, I want to jump right in actually to segment 2, which is a listener question section and a bit of information a actual client and a listener shared with me. But I don't want to skip over Watch Your Step. Watch Your Step is a section that I've had in my podcast from the beginning. It's just there's so much information out there that it's hard to know what to avoid and what to watch out for. And I hope it's my little part, my little give back to you, the listener, to just be paying attention to what might be behind the curtain, under the hood, so to speak, on the news that's out there. Because what has happened is that we live in a 24-hour a day, 365 days per year news cycle. And every website, every news channel, every financial website and channel, they all need content. They are starved for content. They need content. So what does that mean? What it means is that basically any Tom, Dick, or Harry, or Susan or Jane can write an article, and there's a really good chance that somebody will publish the article. And I'll share something with you later on in the episode to kind of highlight that a little bit. But the idea that I'm getting at is that every one of these websites needs content 24 hours a day. So the content quality is extremely lacking in many cases. So please, the things that I share in Watch Your Step are items that I read out there that I call let's just say I call BS. Like, wait a minute, that doesn't make sense. Or, hey, what about X? What about Y? And because they're not telling the whole story, or they're just flat out getting it wrong, in my opinion. So this week, actually, I do want to focus on Watch Your Step. I want to focus on the credit freeze. I have been talking about it on this show for, several months. I have sprinkled it into my episodes, but I really want to focus on it because it amazes me how many people still don't know about all of the nightmare data breaches that continue to happen, where your social security number, your birthday, all of your information is basically just stolen and sent out into the black web, the dark web, that is going to be turned into someone's new identity, their new lease, their new car purchase, their new job, right? Your identity is out there in so many breaches that have continued to happen, and yet I rarely hear anybody writing articles and pushing the idea of freeze your credit. Freeze your credit means you contact online the 3 primary credit bureaus: TransUnion, Equifax, and Experian. They all have websites specifically for this purpose, you type in freeze my credit, Equifax, freeze my credit, TransUnion. Super easy. Make sure that you go to their website. Don't get tricked into going to someone else's website that they'll charge you money to do it for you. That's a scam. You got to go to transunion.com or whatever their website is, Equifax. Go to them directly and freeze your credit. So here's what happens. Just recently, just so you know, there was another data breach at a big company. So this was Saks Fifth Avenue. Saks Fifth Avenue, major retailer, lost an estimated 5 million client identity files, meaning socials, credit card numbers, birthdays, addresses, you name it. What is a card, a retail store with a credit card, what do they collect on you to give you a credit card? Everything, right? Your previous addresses, your birthdays, the birthdays of your family. I mean, you name it. The only thing that they don't have on you is your retina scan and your thumbprint. So data breach at Saks Fifth Avenue. Another major healthcare providers have had data breaches in 2018. So here's the process for freezing your credit. And here's the reason behind it. The process is super simple. You go to TransUnion and you search for their credit freeze and you go through the process. Now, just so you know, when you freeze your credit on TransUnion, for example, or Equifax or Experian, they're going to ask you for your social security number, for your birthday, for all of your info, so they can verify that you are you before they freeze your credit. That's why it's so important. Make sure that you are at TransUnion's website, not some scammer site that says they'll do it for you. You've got to be at TransUnion or Equifax or Experian's website, and they will verify your information, and then you will pay $10 to freeze your credit. And now, anytime anyone who might have gotten your identity in part of one of these data breaches, they cannot use your social security number and your information to open up an apartment lease. They can't get a car. They can't get a job. Anything that requires a credit check, which nowadays everything requires a credit check, will come back with your credit is frozen. They will not be able to get your credit information from any of the credit bureaus. Now, what if you want to go get your own loan? You need to refi your house or buy a car. Well, this happened to me a few months ago. I have my credit frozen, my wife's credit frozen, and I totally forgot, and we're going to get my daughter's credit frozen. The process was, so unfreezing credit. I helped my daughter buy a car. Well, we needed to get a loan to buy the car because if you can get really low interest rates, never pay cash for a car, especially if it's a good asset. Now, that's a whole different topic. I got a loan for this car for her, and it came back, the credit department came back and said, hey, we can't run your credit. Oh, I said, I'm sorry, I forgot. My credit is frozen. I said, which credit bureau do you need to run my credit with? And they said, Equifax. I said, okay. And I went to Equifax and I I thawed my credit for 24 hours. The car loan was sent back in for a credit check. Everything's fine. 24 hours later, the door slammed shut again on my Equifax credit history and my credit. The idea is super easy. That's how it works, right? The process, you sign in, you freeze your credit. Takes about 5-10 minutes at the most. I did all three. Equifax, I believe, is still giving the credit freeze for free. TransUnion and Experian charge $10. Totally worth it. And then your credit is locked up. No one can open accounts or access and use your social to do anything if your credit is frozen. So that's my watch your step tip of the week, is really go get your credit frozen. Get yourself frozen, folks. All right, now, segment 2 is actually brought to us this week by one of my great listeners. But last week, I also had a rant on pot and Bitcoin, okay? Last week was my rant on the marijuana industry and Bitcoin. I had some questions come up at a friend's wedding, and I've gotten a lot of really fun feedback on my take on pot and Bitcoin. Check it out on the last episode if you want to go back and listen to that. But this week, okay, you'll notice the title of the podcast: Life Insurance of the Rich and Famous, right? So thank you to one of my clients and a regular listener, Robert, up in Granite Bay, California, for bringing this to my attention. He shared an article about Michigan University football coach Jim Harbaugh. Now, if you don't know, Jim Harbaugh came out of the NFL back into the college world because Michigan, wooed him away from the NFL and into college football. That rarely ever happens, where you get the opposite direction, NFL to college. You might ask, well, how did they take this NFL football coach and get him into college again? Well, the answer was a lot of money, okay? It was a lot of money. So the article that Rob shared with me was from ESPN, and it detailed Jim Harbaugh's increased compensation through a unique life insurance plan. Hear me, a life insurance plan that was included in the comp package for a big name football coach to come to Michigan University, okay? Now, here's the basics of the plan. Michigan, the school, will pay a $5 million salary through year 6 of their contract deal. $5 million a year for 6 years, $30 million deal. Hint, hint, Jim Harbaugh is what you might consider a rich and or famous. Yes, he's both. Very high income, obviously high net worth individual. Okay? Michigan will also, check this out, $5 million salary. Michigan will also loan Harbaugh $4 million in the first year and $2 million for the next 5 years of the contract. What? They're going to loan him money. Oh, hint, hint, loans, proceeds that you receive from a loan, those are not taxable income when you get a loan, okay? Loan money will be used to pay premiums on a life insurance policy, hint, a cash value life insurance policy. The loans from Michigan to Harbaugh do not need to be paid back as long as the life insurance policy stays in force. Why in the world would a school with a multi-million-dollar endowment waste, and I do air quotes, waste money on what Dave Ramsey calls the worst investment on the planet? Oh, yes. If you listen to Dave, and you know I love Dave Ramsey, if you listen to Dave Ramsey, he would tell you that cash value life insurance is the spawn of the devil, and anyone that would ever sell you cash value insurance, they are the worst people on the planet as well, right? So why in the world would a university with a multi-million-dollar endowment, obviously huge financial planner power on their team, right? Why would they do this, huh? Maybe it's because it's amazing. Maybe because it's an incredible strategy to get this, to bring this big, powerful NFL name coach to your school, right? And maybe because the university gets a large amount, and I say large amount of money, in the form of a death benefit someday. When Jim Harbaugh dies, the university gets paid tax-free, right? Huge. And you can better believe that the death benefit is and will always be much, much greater than the loans paid by the university to Harbaugh or the premiums paid into the policy. Okay? It's incredible, right? It's absolutely incredible. Now, side note in the article, okay? Side note. The groundwork of this plan for Harbaugh's compensation pack to woo him to Michigan was put forth by the former CEO of Steelcase Corporation, Jim Hackett. Now, Jim Hackett was CEO of Steelcase, major international company, right? Hackett says that the deal, like the one that Harbaugh's doing, is very common in the corporate world. Hear me there. It's common in the corporate compensation world. So I did a simple search just because I like to dig in a little deeper, right? A simple search. GE, General Electric, forked over $314,000 in 1 year for their CEOs 2 life insurance plans. The most among any CEOs in the Standard & Poor's index, right? The 100. This is according to Bloomberg, so I'm not making it up. It's just, here are the facts. General Electric Corporation forked over $314,000 to pay premiums for 2 life insurance plans for their CEO. Now, his life insurance death benefit is over $22 million. $22 million in tax-free death benefit for the CEO as part of his comp package. Okay? Unbelievable, right? That's huge. Now, it is said that such policies for these big-name CEOs and high-income corporate types will help their heirs pay estate taxes. Oh, yes, it'll help them pay estate taxes. I call BS on that, okay? Because people will say, well, yes, we're, of course, getting this large life insurance death benefit for our wonderful CEO so that the CEO doesn't have to pay the family doesn't have the money to pay the estate taxes, okay? I'll come back to that in a sec. In 2008, 52% of the Fortune 500 companies offered supplemental life insurance policies to their CEOs. Okay? 52%. That's pretty big. That's a lot. Okay? But let me talk about this estate tax thing. This life insurance benefit that these CEOs have is in many cases, as it is with Harbaugh in this story, massive. They are huge, millions and millions and millions of dollars of tax-free death benefit will pay out, right? And so many times I hear these articles say that, oh, it's to pay the estate taxes. Please, come on. Do you know why? And my opinion, Kraig's opinion alert. Do you know why Bill Gates doesn't really care about the estate tax? It's because his family's not going to worry about paying the estate tax because he's already given away most of his money and his fortune to the Bill and Melinda Gates Foundation. And foundations don't pay taxes, right? I mean, that's the key here. Folks who have financial planners, frankly, like me, the income engineer, they hear strategies for structuring their estates in such a way to mitigate and in many cases eliminate estate taxes. So this idea of life insurance will go to pay estate taxes, I call BS on that. You know where that the CEO that I mentioned from GE, here's my take on it. Where's the $22 million of life insurance benefit when he dies someday? Where's that money going to go? It's going to go right into the coffers of one shape or size or another of the family estate, of the legacy for his family, and it will just boost the long-term legacy wealth of that family. Highly unlikely that CEOs with these kind of advisors are going to pay massive estate taxes in their family legacy. They're not, okay? When you go on to look at it, other CEOs have also amassed fortunes worth of executive life insurance coverage, right? The CEO of 3M Corporation, $10 million death benefit. The ExxonMobil CEO and Honeywell CEO, $11 and $10 million respectively of death benefit. That's massive amounts of cash value life insurance, right? Folks, this is big business that most average folks don't ever get introduced to. And it's not because it won't work in the average household. It's because the average financial planner doesn't understand it, right? And I just have to say, I guess cash value life insurance is a terrible idea and should only be used by the rich and powerful. Us common folk wouldn't want to have anything to do with wealth transfer and empire building strategies of the rich, right? Of course not. We wouldn't want to actually do anything like that, Mr. Ramsey. Ugh, drives me nuts, right? Here we are where we've got stories like Mr. Harbaugh that actually uses cash value life insurance in this awesome way. I mean, it is truly awesome because, frankly, if you look at the compensation package for Mr. Harbaugh coming into Michigan, highly unlikely that the school would have been able to woo him away with just straight up salary of $6, $7, $8, $9 million cash every year. That would have been difficult. But using a life insurance and a loan process, often called a split dollar type arrangement, using that strategy allowed them to attract someone to their organization that they might have otherwise not been able to get, right? So, I've got to make another comment, right? Because people will see this, well, I'm not rich. And I say, you know what? That's fine. Mediocrity is easy to settle for. It's so easy to settle for. I'm here to tell you, wake up. If you don't actually own whole life assets, cash value assets, you might want to learn what the rich already know, have learned from their advisors. You might actually want to learn what they know, right? That's what I'm saying. I'm only saying learn something. Pull your head out of the sand or out of the Dave Ramsey dark hole that you might be in. And I use that as Dave Ramsey in air quotes because that could refer to any financial entertainer or uneducated financial advisor who doesn't understand cash value whole life insurance. Okay? They don't understand it. You don't have to live and settle for mediocrity or what air quotes the common folk are doing, right? These things are open to everyone. The tax code is not exclusive to Jim Harbaugh because he makes $5 million a year. It is not exclusively his domain. The benefits of cash value life insurance can be applied in so many different circumstances. It's just that most advisors don't understand it, and most people truly don't understand it. So please, if you have questions about it, you want to learn more about it, hit me up with an email, Kraig@kraigstrom.com, Kraig with a K, at kraigstrom.com, and I'll take you through my conversation that I have with clients about cash value life insurance. And just so you know, I am the first one to tell people that it is not a solution to anything in particular. It can be used as part of a plan. I love cash value life insurance as part of a plan, as part of a strategy. Don't let anybody try and convince you that it is like, this is the best thing for retirement. No, it's not. It's part of a strategy for retirement. For sure, it could be, right? But it's not the solution. Now, next week, I am going to cover something in more depth. This was a question that came up. It was on the idea of collateral lending. This was a conversation that made someone's eyes just bug out. He had no idea, really understanding what collateral lending is. We're going to talk about that next week. Now, that's going to wrap it up for today. Please keep your questions coming. Thank you again, Rob, for sharing that article. I got to go take a blood pressure pill after I get all ranting about this kind of stuff. You all are awesome. Thanks for listening. Please don't forget, go to iTunes, leave me a fantastic review. And if you have questions, send them to Kraig@kraigstrom.com. I'll talk to you again soon.
Thank you for for listening to the Personal Pension Radio podcast. If you missed anything during the show, that's okay. We took the notes for you. Check the show notes for links, offers, and a full transcript. And don't forget to head over to personalpensionradio.com and download your free retirement income report. While you are there, we would appreciate some iTunes love. Please leave us a fantastic rating on iTunes by going to personalpensionradio.com/iTunes. Thanks again for listening.
Now for the disclosure. Information presented is for educational purposes only and is not intended for solicitation, sale or purchase of any security or financial product. Be sure to first consult with a qualified financial advisor and your tax professional before implementing any strategy discussed here. The term personal pension refers to a marketing name designed to educate future retirees and retirees about the economic principles behind creating their own pension-like income. The term personal pension is not intended to be confused with a defined benefit pension plan offered by an employer or by a government entity.